Welcome to the Deep Dive. We're the place where we sift through, stacks of sources, articles, filings, research to pull out the key insights you really need. Today, we're taking a close look into the portfolio of Mohnish Pabrai. He's obviously a big name in value investing, a deep student of Buffett, and something pretty significant just hit the wires, you could say. We've got Q3 2025 13F filing from Pabrai Investments, and wow, it confirms a really major, highly concentrated bet, and it's in one of the most, let's say, distressed and leveraged sectors out there. Yeah, the filing shows Pabrai acquired exactly 24,442,332 shares of Transocean Ltd. That's ticker RRASHE. The position's valued at just over $76 million. So this isn't your typical diversification play. No, not at all. This is pure conviction. Yeah. It's a massive wager on the offshore drilling cycle turning, but maybe more fundamentally, it's a bet on, survival, asset scarcity, and those sort of nonlinear returns. So our mission today is to really unpack the thinking behind this.
We're going to connect Pabrai's original Don-Ho philosophy, the one about buying businesses when they look like they're about to go under, say. We'll connect that to Transocean's very latest Q3 2025 operational results, their financials. We want to show you exactly why Pabrai might have seen low risk where, frankly, almost everyone else just saw disaster. And, whether the patience that's needed, this multi-year waiting game, is actually starting to pay off now.
That's exactly it. That's the perfect frame for this. Because Transocean, it's really a textbook example of a classic Don-Ho play. The whole idea is investing right at the point of, maximum pessimism. You look for these deeply distressed, super cyclical industries. And offshore drilling, post-2014, it's been absolutely brutal. All right, it became famous for its insane debt load, its incredibly high perceived risk. But that's the beauty of the Don-Ho thesis, right? It specifically looks for these high distress, high uncertainty situations because that's where you find the potential for truly asymmetric returns. Pabrai's hunting for those heads I win, tails I don't lose much scenarios. The idea is the downside, the risk of permanently losing your capital has got to be minimal, usually because the physical assets are just so cheap compared to what it would cost to replace them. But the upside, if the cycle turns, it needs to be exponential, like multi-bagger potential. And the fact that this Q3 filing confirms such a huge position suggests he thinks that turn isn't just coming. It's happening right now. It's accelerating.
Okay, let's really unpack that philosophy then, because everything hinges on this, right? Before we even touch the Q3 numbers, we need to grasp the conceptual safety net here. What's the core Don-Ho idea that lets someone like Pabrai look at Transocean's balance sheet? Billions in debt staring them down and still think, yeah, this is a sensible, maybe even low-risk bet. Because, for most people, huge leverage just streams high risk. End of story.
That's a great question, and it really gets to the core of the Pabrai mindset. The Donzo approach, which he adapted, from the business culture in Gujarat, India, it focuses on these really concentrated, high-conviction bets. And the key insight, I think, is understanding the difference between uncertainty and risk. They sound similar, but they're not the same thing here. So back in the 2018 to 2020 period when Pabrai was likely building his initial thesis, the uncertainty around a rig was incredibly high. You had no idea when oil prices would recover or when exactly they'd manage to refinance all that debt. Massive uncertainty. But the risk, the actual risk of losing everything, of permanent capital loss, was viewed as low. Now why? Because the market price had fallen so far below the, let's call it the underlying economic value of the physical assets. The assets being these premium, ultra-deepwater, UDW, and harsh environment HE floating rigs. These are gigantic, multi-hundred-million-dollar drill ships. They're absolutely critical for future global oil supply. But the stock price back then, it implied they were worth almost nothing, like scrap metal value. Pabrai's looking for assets trading at, maybe 5 or even 10 times less than their real intrinsic value. And you only get those kinds of crazy discounts when the market is just completely paralyzed by fear, when it totally ignores two key things. One, the enormous cost to replace these giant complex machines. And two, what the cash flows should look like in a normal recovered part of the cycle.
Hold on, though. If the stock plunged, say, 80 or 90% before he got heavily involved, how can you really call that low risk? Sounds like the definition of high risk for whoever bought it earlier.
But that's the critical distinction, and it forces you to rethink what risk actually means in this context. The risk Pabrai is trying to avoid is the risk of permanent capital impairment. That means the business fundamentally goes bust, the assets become worthless, your investment disappears. The fact that the stock price had already fallen so dramatically meant that for a new investor coming in, like Pabrai presumably did, a lot of that downside was already baked into the price. The market had already punished it severely. So if the company could just avoid bankruptcy, which was the huge uncertainty, then the equity value had the potential to bounce back incredibly strongly, simply because the underlying asset value provided a sort of floor way higher higher than the stock price. The risk, therefore, wasn't so much about the rigs stopping work. It was primarily about the timing and execution of managing the debt. Could they bridge the gap? And that point about timing takes us right into the trough context. We need to remember just how bad things were in 2018, 2019. This was after the huge oil price collapse in 2014. It was just years of pain and capital destruction in the offshore sector. Globally, utilization rates for offshore rigs were disastrously low, consistently stuck between like 62% and 69%. Most companies were just bleeding cash. They weren't even covering operating costs, let alone thinking about paying down debt.
62 to 69% utilization.
Yeah.
That sounds low, but what does it actually mean for a company like Transocean? I mean, these rigs cost a fortune just to sit there, right? Even if they aren't drilling.
It means they're hemorrhaging money fast. Yeah, think about it like owning a huge, super expensive hotel, maybe a $700 million hotel. But only 65% of your rooms are filled. You still have to pay for heating the whole place, all the staff, all the maintenance. That operational leverage, which is great on the way up, just crushes you on the way down. And the stock prices back then, they absolutely reflected that deep, deep pessimism. But this is the crucial observation. The thing that separates the deep value thinker from the crowd, despite all that misery everywhere else, demand for the really high-end premium assets was already showing faint signs of life. The market was starting to bifurcate, to split. While the older, more generic rigs were still basically dead in the water, demand for the high-specification equipment, which is exactly what Transocean specializes in, actually saw day rates tick up by maybe 25% in 2018. That was a subtle but critical signal. It showed that operators, the oil companies, were willing to pay a premium for the best, most capable rigs, because those top-tier assets reduce risk when you're drilling in these complex, dangerous deepwater environments. Pabrai likely saw that the industry wasn't going to recover evenly. It would recover from the top down. Okay. So the bet was, buy the best quality stuff when it's priced like junk, because that specialized high-end market will recover first and fastest, even if the broader market stays weak. You ride the quality wave out of the downturn.
Exactly. It's second-order thinking. The Don-Ho approach here was about separating the operational performance, which was actually okay because they had existing long-term contracts, from the survival risk, which was purely about managing the debt maturities.
Yeah.
The whole survival bet relied on management's ability to use that strong, long-duration contract backlog. We'll get into that as a financial bridge. Basically, could they use guaranteed future income to wait out the storm until the market forces, supply and demand, fix the imbalance? If they survived the debt crunch, the structural scarcity of their unique assets almost guaranteed a huge payoff eventually. Okay, this is where we pivot to the actual hardware, the operational reality. We've got the philosophy down. Now, what specific competitive advantage, something really hard to copy, did Transocean actually have that made it the likely survivor, the chosen one, if you will, in this absolutely brutal industry? It can't just be about having a lot of rigs.
Right. It's not just size. The core moat for Transocean is specialization and increasingly scarcity. Their fleet is deliberately focused almost entirely on the most technically challenging work. Ultra-deepwater, UDW, and harsh environment, HE. They have the largest, most advanced fleet globally in these specific niches. Back in 2019, they were running something like 28 UDW floaters and 14 HEH floaters. For them, this isn't a commodity business like, say, shallow water jackups. It's a high-end specialty service. But the real technical barrier, the thing that sets them apart now, is what they call the 8th generation edge. Transocean owns and operates the Deepwater Titan and the Deepwater Atlas. And these are arguably the only two true 8th generation drill ships in the world. They represent the absolute peak of current deepwater drilling technology.
Okay, let's pause there. We need to really detail that for listeners.
Yeah.
What is the actual difference? What makes an 8th gen rig so much better than, say, a 7th gen?
Well, the main technical differentiator is the well control system pressure rating. These 8G ships, the Titan and Atlas, are specifically designed with 20,000 psi pounds per square inch well control systems. Now, standard rigs, even pretty advanced 7th gen ones, might top out at 10,000 or maybe 15,000 psi, 20,000 psi. That's a massive leap in capability. Think about it like this. Some of these deep water reservoirs, especially the ones that are high pressure and high temperature, HPHT they call them, are incredibly difficult and dangerous to drill into. Trying to tap one with a standard 15K PSI rig is like, I don't know, trying to use a regular garden hose on a high-pressure fire hydrant. The system just can't handle the force safely. If the pressure coming out of the well exceeds the rating of your blowout preventer, your BOP stack, you risk a catastrophic failure, like Macondo-level failure. So this 20,000 PSI capability literally unlocks access to entire reservoirs, like Chevron's big anchor project in the Gulf of Mexico, that are simply off-limits, physically inaccessible to almost the entire rest of the global fleet.
Wow, so having a 20K PSI rig isn't just a nice-to-have feature. It's like having a key to a treasure chest that nobody else can open. It literally removes competitors from even bidding on certain high-value projects.
Exactly. It's effectively a temporary technical monopoly on some of the most challenging and potentially lucrative deepwater projects globally. And crucially, that technical edge translates directly and non-linearly into pricing power, and that pricing power is the engine that drives the whole investment thesis. The economics become really compelling. Look, a decent competitive 6th or even 7th gen rig might be earning, let's say, $400,000 to maybe $500,000 per day right now. But Transocean's top 7th gen rigs, and especially those HE ships, they're commanding rates well into the $500K range, pushing toward $650,000 or even higher for this kind of specialized, complex work. That difference, that premium of, say, $150,000 to $200,000 per day, it just compounds incredibly over a typical multi-year contract. We're talking hundreds of millions in extra revenue that flows mostly to the bottom line because the base operating costs are similar. This quality gap is what lets Transocean generate the cash to pay down debt and potentially reward shareholders, while weaker players are still just trying to survive.
And this advantage, this asset superiority, it's protected not just by the technology itself, but also by that massive supply-side collapse you mentioned, the one that happened after 2014. Can you talk more about why that painful industry shakeout was actually essential for this recovery we're seeing now?
Oh, it was absolutely brutal, but completely necessary for the long-term health of the industry, ironically. That multi-year downturn forced this incredibly aggressive supply rationalization. People call it the scrap and burn phase. Companies basically had no choice but to systematically retire their older, less capable rigs. Why? Because the cost to reactivate them from being stacked, plus maintain them, plus get them certified, it just made no economic sense given the rock-bottom day rates available back then. Just look at 2018 alone. The industry permanently scrapped something like 37 jackups and 20 floaters. Gone forever. This relentless removal of older, lower-spec supply is precisely what created the structural shortage, the scarcity of capable rigs that we're benefiting from today. And here's the other critical piece. There are virtually no new rigs being built to replace the ones that were scrapped. New orders have completely dried up. It's just not economically viable right now. Think about it. A new high-spec drill ship, especially an 8G one, costs somewhere between $600 million and $750 million to build. No bank is going to finance that massive cost unless the oil company customer commits to a very, very long-term contract, maybe 7, 8, even 10 years at peak cycle day rates. We're talking maybe $800,000 or $900,000 a day.
All right, so the math just doesn't add up currently. The upfront cost is too huge, and the kind of super long, super high rate contracts needed to justify it, they just aren't being offered yet.
Exactly. And even if, hypothetically, someone decided today, okay, let's order a new HG rig, it would still take probably 4 to 5 years just to build and deliver it. So what does that mean? It means the existing high specification fleet, the one Transocean dominates, is essentially fixed for the next 5 years, maybe longer. They're sitting on this irreplaceable premium fleet. Meanwhile, their competitors either scrapped their older rigs or have them cold stacked, needing huge investment to reactivate, and no new players can realistically afford to jump into the market right now. This structural supply rigidity is the bedrock of their future pricing power. And Transocean is actively reinforcing this scarcity themselves. They've said they plan to dispose of 5 more older stacked rigs. That shows continued discipline. And look at their strategy for the rigs they do have stacked. They've got, I think, 3 deepwater drill ships still in cold stack, but management is being really firm. They will not pay the $100 million to $200 million it costs to reactivate those rigs themselves. If a customer wants one of those rigs back in service, the customer has to fund that massive reactivation cost as part of the contract. That does 2 things. Protects Transocean's cash, obviously, but it also acts as a kind of market signal. It means those marginal assets only come back online when demand is so strong, so desperate, that the customer is willing to front that huge capital cost. It reinforces the scarcity for the active fleet.
Okay, this raises the big looming question, though. The one that really defined the distressed nature of this investment for years and brings us to the financial engineering that allowed this whole bet to survive that long waiting period. How could a company with just massive crippling debt, the main reason it was labeled distressed, ever be considered low risk in the Pabrai framework? The answer has to be in the financial defenses they built, right?
Absolutely. The answer, plain and simple, was the backlog, the contracted revenue backlog. That was the financial shield, the liquidity bridge, the thing that provided the absolutely essential margin of safety. Remember, after they acquired Ocean Rig back in late 2018, their backlog that's guaranteed future revenue from existing contracts stood at an incredible $12.2 billion. Billion dollars with a B. And even as they worked through some of that, by October 2019, it was still a massive $10.8 billion. For an investor like Pabrai, looking through that Danto lens, this backlog was like an insurance policy. It guaranteed a stream of revenue that was large enough to cover the huge fixed operating costs of the fleet and, critically, to make the interest payments on all that debt during the worst of the downturn. You had the market assigning almost no value to the physical rigs and completely panicking about the upcoming debt maturities, while seemingly ignoring this colossal, locked-in, guaranteed revenue stream that could keep the company alive until the cycle inevitably turned.
So the underlying operational reality, backed by that huge backlog, meant that even though they were reporting these big gap accounting losses, which you'd expect during a period of asset write-downs, the core drilling business was actually still viable, still generating cash.
Exactly right. Take Q4 2018 as an example. The headline GAAP net loss was huge, like $242 million. Looks terrible on the surface, but you have to dig deeper. Despite that accounting loss, the company actually generated $238 million in positive cash flow from its operating activities in that same quarter. And their adjusted normalized EBITDA margin, which reflects operational profitability, was a healthy 34%. That positive operating cash flow, driven almost entirely by drilling activity secured by the backlog, was the key. It allowed them to keep the lights on, keep their highly skilled crews employed, pay the day-to-day operating expenses, and, crucially, service the interest on the mountain of debt.
Right.
Without that backlog cushion, the operational survival story would have looked very different very quickly.
But survival still meant constantly juggling that debt wall, right? Those big chunks of debt coming due that could trigger bankruptcy if they couldn't pay or refinance. So management had to somehow turn that near-term risk of insolvency into just a longer-term expense.
Yes, it required relentless focus on debt management. Proactive financial maneuvering was key. This meant constantly working to push out the debt maturity dates as far into the future as possible. Sometimes that meant accepting higher interest rates on the new debt, and sometimes, critically, it meant strategic dilution, issuing new shares. For instance, they recently did some equity issuances that brought in about $421 million net, specifically earmarked to pay down upcoming debt. Now, normally, shareholders hate dilution, especially when the stock price is already low, because it reduces their ownership percentage. But in this specific Danho context, where the alternative is potential bankruptcy, this strategic dilution was arguably the lesser of two evils. It was seen as a necessary, even low-risk mechanism. Think about it. If you're staring down the barrel of Chapter 11, issuing a few $100 million worth of stock, even at a depressed price, to push that debt wall out by several years is a net positive. The value you preserve by avoiding bankruptcy, by keeping the company alive so the asset value thesis can play out, far outweighs the pain of that dilution. Survival was job number one, and these financial maneuvers were essential to securing that survival component.
Okay, that sets the stage perfectly for where we are now. We had the Flossie Danha, we had the Moat, those irreplaceable high-spec assets, and we had the backlog and the financial maneuvering to survive. So let's fast forward to today. We have the Q3 2025 results in hand. This is the data that Pabrai himself would have been looking at closely before confirming that huge purchase in his latest filing. So the big question is that long-term thesis, the bet on scarcity and pricing power, finally showing up clearly on the balance sheet.
Well, the Q3 2025 results are actually a perfect illustration of why you absolutely cannot rely on the headline GAAP number when you're looking at these deep value cyclical turnarounds. The headline number is, frankly, shocking. A GAAP net loss of $1.923 billion. That's $2 per share. It sounds like a complete disaster, right?
Yeah, nearly $2 billion loss.
Oh.
How does that happen if the cycle is supposed to be turning upwards?
It happens because of accounting rules, specifically around asset impairment. That massive GAAP loss was driven almost entirely by a one-off, non-cash charge, a $1.908 billion loss on the impairment of assets. Basically, they had to write down the book value of some of their older, less utilized rigs to bring them in line with the harsh market reality established over the last few years. It's essentially a historical cleanup, a non-cash adjustment. It tells you very little about how the business is actually performing today, because the operational reality, when you strip out that huge non-cash impairment charge, is dramatically different. And it absolutely confirms the core Pabrai thesis is playing out. Adjusted net income for Q3 2025 was actually a profit of $62 million. That's 0.06 cents per diluted share in positive earnings. And even more importantly, look at adjusted EBITDA. That's a measure of cash-based operational profit. It hit $397 million for the quarter.
Wow, $397 million adjusted EBITDA. And you mentioned the margin earlier, an adjusted EBITDA margin of 38.7%. That sounds pretty healthy, and it's improving.
Absolutely. That 38.7% margin is up significantly, sequentially, from 34.9% in Q2 2025. So what you're seeing is exactly what the thesis predicted. As day rates climb higher and more rigs go back to work, utilization increases, the inherent operating leverage of this business kicks in powerfully. A larger chunk of that new revenue drops straight to the bottom line, driving profit margins up fast. And the cash flow confirms this operational strength too. Cash provided by operating activities was $246 million in Q3. That's a big jump, up $118 million just from the previous quarter. This shows the company is now generating significant real cash from its actual drilling operations. And that cash is the lifeblood needed to start tackling the debt pile.
Okay, so stripping out the accounting noise, operationally the company is making decent money and generating substantial cash. The machine is finally firing on more cylinders thanks to those utilization gains we talked about.
Exactly. The operational momentum is clear in the numbers. Contract drilling revenues went up by $40 million from Q2 to Q3, hitting $1.03 billion. Management specifically said this was driven by higher utilization and better day rates coming through. And look at the key utilization metric. Total fleet average rig utilization jumped massively. It hit 76.0% in Q3 2025. Compare that to just 63.9% in Q3 of the previous year. That's a huge leap, over 12 percentage points in just 1 year. That's monumental in this kind of capital-intensive industry. People often talk about crossing that 75% utilization threshold as being the magic number for offshore drillers. It's a point where the whole fleet really starts generating significant operating leverage. Below maybe 65%, you're often losing money overall. Above 75%, you start printing cash. And it's not just utilization. Revenue efficiency, which measures how well the rigs perform when they are working, also improved nicely, up to 97.5% from 94.5% a year ago. So when the rigs are contracted, they're running smoothly and earning their keep.
And now that the company is generating this real cash flow again, management can finally start to aggressively attack the very problem that created this whole deep value opportunity in the first place, that massive debt load.
Yes, exactly. The CEO, Keelan Adamson, was very clear on the Q3 earnings call. He said they're taking decisive steps now to accelerate debt reduction. The specific target they laid out is to cut total debt by about $1.2 billion by the end of 2025. And this isn't just shuffling deck chairs. Reducing the principal debt by $1.2 billion is expected to cut their annual interest expense by around $83 million. Think about that. $83 million less cash going out the door each year just to service debt. That flows directly back into the company's cash flow, improving profitability further, and crucially reducing the need for potentially dilutive equity raises in the future to handle maturities. The company is clearly shifting gears. They're moving from pure survival mode, which relied heavily on that financial engineering we discussed, into a growth and deleveraging mode that's now being funded by strong operational performance. This is exactly the kind of validation that Don Hunt's thesis was waiting for.
What's really striking now is seeing how that asset scarcity, which was kind of the theoretical underpinning of the whole trade, is now showing up directly and almost violently in the pricing, in the day rates. It validates that whole nonlinear return idea, right? Because the extra revenue from higher rates just drops massively to the bottom line.
Oh, the day rate acceleration is the absolute proof pudding for the scarcity thesis. We're seeing premium day rates being signed now that don't just reflect the technical superiority of the 7G and HG fleet, but frankly, they reflect a growing sense of urgency, maybe even desperation among the customers, the oil companies. Let's use some concrete examples from recent contracts. The Deepwater Atlas, that's one of the unique HG rigs BP, just exercised a 365-day option on it in the U.S. Gulf of Mexico at a stunning $635,000 per day. That one option adds $232 million to the backlog. Or look at the Deepwater Conqueror, a top-tier 7G rig. It just secured a new one-year contract starting soon at $530,000 a day. And the Deepwater Invictus signed a huge and 1,095-day contract that's 3 years, adding $531 million to the backlog.
Wow.
When you compare those numbers, 530K, 635K, to where rates were just a couple of years ago, maybe closer to $300,000 a day or even less during the absolute bottom, that difference is just enormous. That's the operating leverage in action, isn't it?
That is exactly the operational leverage. The basic cost to operate one of these premium drill ships, crew, maintenance, insurance, shore-based support, it's relatively fixed. Let's say it's somewhere in the high $200,000 or low $300,000 per day, just for round numbers. So when your revenue per day jumps from, say, $350,000 to $635,000, the extra $285,000 per day, almost all of that increase is pure profit contribution because the fixed costs are already covered. This is the textbook definition of operating leverage working in your favor. Small increases in price lead to massive increases in profit. That's how you get those nonlinear returns Pabrai was betting on. And it's not just the rate, it's the pace of new contracts being signed. The momentum of new awards is picking up speed dramatically, which suggests that customer confidence is really returning across the entire deepwater sector. We're moving beyond just one-off deals. Companies are starting to plan further ahead again.
Yeah, the contract acceleration story is maybe the most powerful qualitative signal that the market turn is real and has legs.
If you measure contract awards in terms of total rig years booked, it accelerated sharply right through 2025. In Q1, they booked about 12 rig years of work. Q2 saw that increase to 14 rig years, and then Q3 jumped again to 18 rig years. That steady sequential climb shows growing confidence and commitment from the oil and gas operators.
So the demand signal is just getting stronger and stronger each quarter. Where does management see this heading next?
We'll get this. Management said on the call they expect a staggering 23 rig years worth of contracts to be awarded in Brazil alone just in Q4 2025. That's almost double the recent quarterly run rate, just from one region. And maybe even more significantly, the CEO highlighted that customers are now planning entire rig lines around exploration, not just drilling development wells in known fields. That's a huge shift in mindset. Committing capital to pure exploration means you're betting on finding new reserves for multi-decade production. He even noted that kind of planning would have seemed reckless just 18 months ago. They also mentioned that many programs are going longer. Customers are locking in rigs for multi-year terms instead of those short 90-day fill-in jobs we saw during the downturn. And they're already in active talks for the rigs that finish contracts in 2026 rigs like the Skyros, Mykonos, CG2, Proteus. The expectation is not much idle time for these premium assets. This forward visibility, sometimes stretching out into 2027 or 2028 now, provides much more certainty around future cash generation. The structural scarcity we talked about. It's forcing customers to commit earlier and for longer durations just to secure the high-capability rigs they need. It proves that asset mode is really working.
So pulling it all together, where is all this accelerating demand actually concentrated geographically? And why does Transocean's specific global footprint matter for capturing those premium day rates we're seeing?
Yeah, Transocean's strategic geographic positioning is key. They're deliberately focused on the highest margin, most technically demanding markets, which reinforces those premium rates and also provides some diversification against, regional political risk or slowdowns. We can really point to 4 key hotspots that are driving demand for their specific kind of high-end fleet. First, you've got the U.S. Gulf of Mexico, the Grana. This is consistently the highest rate market in the world right now, precisely because it's home to those ultra-complex 20,000 PSI, high-pressure, high-temperature projects like Anchor that only a couple of rigs can handle. The technical bar is just incredibly high there. But what's also really important structurally in the draw now is predictability. The regulatory environment seems to have stabilized significantly. There was legislation passed, sometimes called the One Big Beautiful Bill, that basically mandates a predictable 15-year schedule for offshore lease sales. There's one coming up in December 2025, and then 2 per year planned right through the 2030s.
And that predictability must be huge for the oil companies planning these massive, multi-billion-dollar projects.
Oh, it's absolutely crucial. That regulatory certainty removes a huge historical risk factor for the operators. If they know the leases will be available on a predictable schedule, they can confidently sanction these enormous multi-year deepwater developments that require exactly the kind of top-tier assets Transocean provides. They need the best rig, and now they have the confidence to commit to it long-term. Okay, second key region, Norway. This is a structurally stable, harsh environment market. The operating conditions there, especially in winter, are incredibly tough, and the safety and environmental regulations are among the strictest in the world. So operators in Norway prioritize technical capability, reliability, and safety records above almost everything else, even cost to some extent. Transocean's specialized harsh environment semi-submersibles like the Transocean Spitsbergen, which recently got extended at a strong $483,000 a day, face almost no competition from lower spec rigs. Those other rigs simply can't operate safely or efficiently year-round in those conditions. It creates a very narrow, high-margin market niche where Transocean is a dominant player. Third major area is Brazil. This continues to be a real anchor market, mainly due to the massive, consistent demand from Petrobras, the national oil company, for high-spec drill ships needed for their huge pre-salt developments. Petrobras tends to operate based on long-term development plans, which provides a really valuable baseline of utilization and revenue stability for Transocean's drillship fleet, even if oil prices get volatile elsewhere. And the sheer volume of work expected just from Brazil in Q4, that 23 rig years number, shows just how foundational it is to the company's cash flow outlook.
And finally, it sounds like we're also seeing diversification into other regions, maybe markets that were pretty weak just a few years ago. That provides some extra upside, too.
Exactly. The Asia-Pacific region is starting to contribute meaningfully again, which is great to see. We've seen some strong contracts recently in Australia. The Transocean Equinox got options exercised at $540,000 a day. And in India, the Dhirubhai Deepwater KG-1 rigs secured a 4-well contract at a solid $410,000 a day. These markets, while maybe historically lagging the JM or Norway on rates, provide really important geographic and customer diversification. It reduces Transocean's reliance on any single region or customer and helps keep the overall global fleet utilization high. And if you step back and connect all these regional dots, the bigger picture emerging is this growing consensus among the major global energy companies. They realize they absolutely need to invest hundreds of billions of dollars in upstream projects over the next 5 to 7 years just to offset the natural decline rates from existing fields and maintain global supply. And a significant and actually growing chunk of that essential investment is being targeted specifically at deepwater resources, the kind of resources where Transocean's premium.
Wow. This has really been a deep dive, tracing that asymmetric bet Mohnish Pabrai confirmed in his Q3 filing. We started way back with the concept of maximum pessimism, this highly leveraged company seemingly on the brink. And we've walked through the layers of the thesis. The operational resilience hidden by accounting losses, the structural scarcity created by years of underinvestment and scrapping, and now finally the tangible evidence of exploding day rates and rising utilization. So the core of the Pabrai-Danto investment case, which seems validated now by these Q3 2025 results and the recent filing, it really was quite simple at its heart, wasn't it? It was a bet on survival, first and foremost, made possible by that huge contract backlog. It was protected by the scarcity of those unique 7G and especially HE assets. And the payoff was always going to come from that nonlinear pricing power once the market turned. The company's ability to just hang on through the debt crisis using that guaranteed revenue stream as a bridge, that was the necessary first step, the lock. And the scarcity of its unique rigs was the key needed to unlock potentially exponential shareholder value when the supply-demand balance finally shifted.
Absolutely. But we should quickly just restate the risks because they're inherent to this volatile sector. They haven't disappeared entirely. First, the debt load, while being addressed, is still considerable. Billions remain. Transocean really needs the cyclical upswing to be high enough and last long enough to allow them to comfortably refinance the remaining debt walls on good terms. Second, oil price volatility is always the elephant in the room. A sharp, sustained crash in crude prices would absolutely slam the brakes on customer spending plans, potentially slowing or even reversing this demand recovery we're seeing. Riggy's fortunes are still fundamentally tied to the price of oil. And third, there's the longer-term energy transition risk. However, you could argue Transocean is somewhat insulated here, maybe better positioned than others. Why? Because they specialize in these massive, complex, deep-water projects. These projects typically have lower carbon intensity per barrel and much lower break-even costs compared to alternatives like, say, U.S. shale or oil sands. These giant deep-water fields also tend to have very long production lives, often decades. So they're likely to be among the last sources of oil production to be phased out in most transition scenarios, providing a kind of defense against really rapid transition pressures compared to shorter cycle, higher cost sources.
So the strategy looking back was conceptually straightforward, even if executing it required immense patience and conviction. Buy these incredibly valuable assets when the market completely ignores their replacement cost and focuses only on the debt. Wait for the inevitable supply shakeout as competitors scrap their older, less capable rigs. And then
Just let basic economics and operational leverage do the heavy lifting once utilization finally climbs back above that critical threshold, maybe 75% or 80%. That massive difference between the fixed break-even cost per day and these new peak cycle day rates generates enormous cash flow.
And that leaves the provocative question for you, the listener, to think about. Given that the supply of these highest specification drill ships, especially the 8G ones, is essentially fixed for the next several years, and given that global demand seems to be just starting its acceleration phase, how much further can this deepwater upcycle actually run? If structural underinvestment continues to enforce extreme supply scarcity for the next, say, 3 to 5 years, if new builds remain uneconomic, where do premium day rates actually top out?
Yeah.
If supply literally cannot respond quickly to rising demand, what's the ceiling?
Definitely some food for thought there. Thanks for joining us for this deep dive. We'll catch you on the next one.